Hey everyone, I'm Jeremy Szafron and welcome to Kitco News. Now, we just witnessed Bitcoin pass the $50,000 mark for the first time in 2 years. It's a move powered by a staggering $1.1 billion in inflows into the new spot Bitcoin ETFs. Now, this landmark event signals a bullish outlook for Bitcoin, and it further amplified by the anticipation of the upcoming halving event in April. We'll break down the chart. And the crypto market isn't the only area buzzing with activity. The S&P 500 passed a new record level, and the steady allure of gold and silver amidst economic shifts reminds us of the intricate interplay between digital and traditional assets. Now, today we're joined by Gary Wagner, our resident technical analyst, no stranger to our audience. Gary, thanks again for joining us today from a sunny Hawaii.
Thanks so much for having me. Great to be here.
Yeah, I'm excited. I mean, we got lots to go into. As I mentioned off the top here, Bitcoin's recent surge passed the $50,000 mark, and it's been one heck of a headline grabber, with analysts attributing part of this rally to the launch of spot Bitcoin ETFs. I'm curious, can you walk us through the technical indicators that signaled this bullish trend? And let's bring that chart up.
Yeah, well, what we're looking at is a weekly chart of Bitcoin futures. And when we look at this, what we see is that, especially last week, we had a tremendous move from about 42,000 all the way up to about 48,000. Of course, today, this week, it crossed over the 50,000. Currently, I believe today up well over 3%. What's interesting is when we look at the high coming in just above 50,000, we can see that that has surpassed the high that came in November. And then, of course, towards the left, we've got these record highs, this being the record high at around 65,000. So on our weekly, we have definitely seen a massive breakout in the last 2 weeks. And as you correctly mentioned, it has a lot to do with the ETF that was just enacted, and there was an outflow at first, and now money seems to be going back into the digital currency.
Yeah, interesting. I mean, let's zoom out a little bit. And how significant is this movement in context of Bitcoin's historical performance?
Well, in terms of the historical performance, as I said, we have surpassed every high except the high that came back in November of 2021. And the previous high was in March, and that's right here. So these are our record highs. From there, we had a long and protracted correction in the market, actually trading to a low of about, 16,000. And this is back in December of 22.
You know, given the ETF's role in this rally, what future trends should we be on the lookout for in the crypto market? I mean, especially as we approach Bitcoin halving in April, how might this influence Bitcoin's technical chart in the short or medium term?
Well, we'll go to a short-term chart. What we're looking at here is a daily chart where each of these candles represents a single day. We also have a Japanese study which we look at these clouds, and this is our breakout. And what we basically have in terms of a candlestick pattern is simply called three white soldiers. It is a continuation pattern. What it simply is looking at is each move after a large green candle falls within the range of the previous one and does that again. We have seen that occur now for 4 consecutive days. If there was major gaps in between those 2 days or any of these days, it could be construed as an exhaustion pattern. But according to Japanese technical analysis, this continuation pattern is signaling that higher prices most likely are ahead. In other words, we haven't hit the peak of this rally.
Yeah, it's interesting. I mean, everybody keeping an eye on it with this ETF inflows. I mentioned off the top, billions pouring in. We also saw a little bit of sell the rumor and sell the news when the ETFs first got approved. So I'm curious, you know, is there any consolidation patterns that investors should note here? Is it just because of the inflows?
Well, I think it's exactly what you mentioned. You can see the consolidation that came in. This is towards the last week in January when it was sitting at around 42,000. In candlesticks, what we look at really is alternating candle color to indicate consolidation in the market. you're not getting higher highs, you're not getting higher lows, nor are you getting any kind of distinctive move. That all changed on Tuesday, February the 6th, when we got our first small green candle. And what I'm going to do is to really give us a sense or a feel is convert our Japanese candlestick to a Henkin-Ashi. And what you can see is it smoothed everything out. Look at the body sizes that you get of these recent moves on this daily chart. And more so, what you want to see in this type of chart is the absence of lower wicks when a market is rallying. Because the difference between a Japanese average and a candlestick chart is how they fix the open. In a candlestick chart, it is identical to a bar chart. The open is the true open. However, in a Japanese average or Henkin-Ashi, they fix the open from the midpoint of the prior day. And so if we look at this candle right here, you can see it matches up exactly at the midpoint of the prior day, midpoint of the prior day. And what that tends to do is to smooth out some of the noise you get when you're looking at daily activity or weekly activity in terms of overall trend. The fact that the body size is growing and that there is an absence of lower wicks really signals exceedingly strong strength in the current trend. And that's impressive.
Yeah, absolutely. I mean, everybody kind of keeping an eye on it. So I guess what I'm hearing, Gary, is according to your analysis, this night might not be, it might bust out here. I mean, 50,000 might not be where we just lie down today.
Absolutely. I mean, what we can do as a market technician, really the only thing we can do, and I've gone back to a weekly, is take a look at current pricing and go across, and we see that it's taken out this one top here, and where we're currently sitting matches up roughly with this area in which it consolidated slightly for a short period of time. But in terms of upside potential, it's got very minor resistance at about 52,000. And then in terms of real resistance, that doesn't come in until about 58,000. So in terms of how much higher it could go based on technical studies looking at where it has been in the past, it is certainly strong and certainly has more upside potential.
Right. And you said resistance there around the 58,000 mark. Is that what I heard?
Yeah, well, all I'm doing to reach that is look at a series of highs. The 58,000 comes from these highs that occurred in May 2021. This one top here, this top occurred prior to the all-time record high. So it went from roughly 60,000 all the way down to lows of 30. And from there, it broke to these highs of 65 and tails at 68,000. So in terms of a market technician, the best we can offer is look to see how high a market traded at a previous time point. And if it's in an uptrend, those are the areas we would look at for potential resistance. But we certainly have a breakout here.
Yeah, no, we're going to be keeping an eye on that. For context, back in January 2023, Bitcoin prices were at $16,500. So what a rally that has been. Okay, let's switch gears over to the equity markets. The S&P 500 has shown remarkable strength recently, hitting a record high. From a technical standpoint, what patterns or levels were key to identifying this upswing? And how does this market align with the broader market sentiment?
Well, of course, it is just a handful of stocks that are moving the S&P to the levels we're seeing. NVIDIA being a big one. It is the high-tech AI-driven equities and companies that are really moving this up. This is in Henkin-Ashi format. We'll simply move it into a candlestick chart, and you'll see it doesn't have that same smoothness, but nonetheless, we see that this market has been on a very strong tact or angle to the upside. And when you're in this area where you're at all-time record highs, it's difficult to predict where that rally could end up at if it continues to move higher. You can see that on this daily chart, there's a little bit of weakness today, but it's still well above 5,000. And that's why I like to use as I said, a Heikin-Ashi, because what that does is it really smooths everything out. And let me just get to that right there. And if you can see the difference, and the key with this is you have good candle size, absence of lower wicks. You can see a couple of points in which it retraced ever so slightly here. This came in end of January, and this point right here that came in on the 19th. This is all this year. So aside from these small price declines, we've had a strong market. And in terms of the angular tact in which it's going up, it's actually gotten steeper. And that's, we've got a market that's got a lot of steam in terms of trend motivation, let's say, left, meaning higher prices ahead. And when we think about what's driving it, which is companies like NVIDIA, Meta, all of the companies that are really honing in on AI, and that being such a hot commodity right now, it's no wonder that we're seeing the S&P do what it's doing. In fact, if I'm correct, I believe that it's a total of 5 to 6 companies that are responsible for about 70% of this move. So it's not a broad-based rally across the board in multiple companies. Rather, it's a very selective few that are really moving the Standard & Poor's 500 higher.
Yeah, for sure. I mean, we're seeing the tech stocks obviously move with record evaluations. I'm curious, though, a little bit about the indicators or the thresholds as an investor we should monitor that might suggest either a continuation or a reversal of this trend.
In this type of a chart, what we would look for would be, if you look at what happened, this is back in November of 23, you notice how there's a large size bodies that begin to contract and diminish. And then you start getting candles that have very small real bodies. The difference between the open and close, wicks become evident on the both lower and upper areas, above and below the real body. So here's where you see a market that is consolidating and showing the potential to move higher, but it could move lower. If we look at points where we actually saw it move down, you will always get a pivot from green, smaller green, and then you'll get that pivot to red like we're getting here. And that signals that we're going into a downtrend. So what would we look for? We would look for body size in this chart style to contract. We'd look for the wicks on the lower end of the real body to appear. And then we would look for very small bodies and a transition as we got here from green to red. And if it's going to actually be a correction, that will continue to lower pricing.
Yeah, and according to your analysis here, I mean, it does look like this trend is going to continue above this 50,000 mark.
Absolutely. Looking at this chart, that is true. The one thing about using a Japanese average, because it's average based, it will lag behind real-time data, so that we'll get acknowledgement of a weakening trend scenario, and that acknowledgement will come a couple of days after the move actually begins to happen. The benefits of this chart is it smooths everything out, takes out the noise. The con side is that since it's using the open as the midpoint of the prior candle, it will tend to lag as moving averages lag, for example, or stochastics or MACD.
Okay. Let's switch over to gold here, Gary. Let's talk about that commodity, obviously, the precious metal, for a moment. You know, given gold's role as a traditional safe haven, which we know, we've seen its price respond to various global economic pressures and obviously opportunities. So break down the current technical landscape for gold. Specifically, what key technical levels should our viewers be monitoring for times of bullish continuation or potential pullback here?
Well, I've just compressed it starting so that we can easily see the beginning of the October rally, which corresponds with some geopolitical tension breaking out in the Middle East. That took the market up to a rather high above 2,000. It comes back down to about 1930. And then we got the all-time record high that was so short-lived, if you blinked, you missed it. And that's when we went well over 2,100. And the following day, this was on a weekend, on Friday, it closed at 2,073. I believe that is the highest close on record. Then it tracked up to past 2,100, broke back down. What we've seen since then is we have a truly defined trend moving to higher pricing. Now we have a compression triangle. We are seeing a series of lower highs, a series of higher lows. And whenever you get a scenario like that, where you get the compression, the idea behind that is as the range reduces, just as when you wind up a spring, the energy builds, and it builds until it hits the apex of this triangle. And then when it breaks, you get a release in energy. Typically, the release is to the prevalent trend direction. So when we look at recent activity, where it was trading at 1820 back in October, moving up well over a couple of $100, and now is compressing, I'm assuming that based on just the technicals alone, not the fundamentals, because we know this has so much to do with when the Federal Reserve cuts rates and a lot of other economic data that's coming out, especially the inflation numbers that will be coming up shortly, you could get a break to the downside. But on a technical basis, you typically look for a return to the prevalent direction of trend, which has obviously been up since October.
Yeah. And you mentioned 2,000. I mean, that seems to be the magic number with gold right now.
I believe that, and I said this right before we broke effectively above 2,000, it was my belief that 2,000 would become the new level of support rather than the current level of resistance. And that's what we were seeing. If we take a look at 2,000 here, you can see it was resistance here, acted as resistance here. And up until then, it never even came close. Once we got the breakout, that became a level of support. So even when we look at these dips, this is 1975, this is 2009, and this is 2022. So when we look at the last three sets of higher lows, we're seeing them really matching up with right around the $2,000 mark. And I think that that is where we have major technical support.
Yeah, absolutely. And we'll be keeping an eye on that economic data that you just referenced too. Of course, we'll have the latest with Kitco News. Gary, turning our attention to silver, we've seen some interesting activity lately. I mean, from a technical standpoint, what are the critical levels of resistance and support that traders should be keeping an eye on for here? I mean, we've been seeing some shorting happening as well. So let's get into silver a little bit here.
Okay, we're looking at a daily chart. On this daily chart, the first thing that I have is this green line here, a 50-day moving average, simple moving average. And that's so we can quickly assess if on a short-term basis, a market is in a bullish or bearish trend and where the sentiment lies. We can see that back at the beginning of the year, it did break below that, which meant that short-term sentiment turned bearish. There is very strong support right around $22 per ounce. We can see that it's hit from 22.19 on one low, 22.30 on the next low. Today's interesting because we have a very small size real body. That's that green portion or rectangle. But look at the high. It traded to a high of $23.16 and is backed off now to $22.82. So it shows you that there was a massive amount of buying, and that level, at least for today, was unsustainable. And that's what I find interesting. Resistance, I would have to peg at 23.25 short term. It is based on the 61.8% retracement, but more importantly, these series of tops, because the way that we look at support and resistance is where we have a market top out or where it finds support. And the way I look at that is if you're on the second floor looking down, you're looking at support. If you're on the first floor looking up, you're looking at resistance, meaning support and resistance are part and parcel of the same thing. So whereas this is an area of resistance right now, once we get, or if we get a solid break above call it 23.25. That area should provide some energy for a breakout. And then you really have no resistance to about 23.50, the 50-day moving average. And a move above there, we'd have to look at the highs that came in December, which are about $24.90.
Okay, and is $24 where that resistance is there? I mean, you know, the potential direction, what do you think here in the near term?
In the near term, I mean, it might sound obvious to say, but we first got to break above 23.25. And once we do that, we have clear sailing at least till the 50-day. Past the 50-day moving average, which is at 23.48, we have to look at this top. And this is what comes in close to $25. It has some lows that come in around 24.33. That would be the area where it could run into, if not resistance, around a profit taking, meaning a short move and a return.
Right. Yeah, absolutely. Well, listen, Gary, I appreciate you making the time for us today. I know that it was a quick one, but we got lots to get to. Thanks again for coming on, Gary Wagner, breaking it all down for us from Hawaii today. Thanks, Gary.
Thanks for having me.
And thank you for joining us today. I'm Jeremy Szafron. Don't forget to subscribe to our YouTube channel for the latest, and we'll see you next time.